gold prices found fresh fuel as the U.S. Bureau of Labor Statistics released benchmark data revision showing payrolls were overstated by 911,000 jobs the year through March 2025. This implies the labor market has been cooling much earlier than initially thought. This also not just lends weight to a cut in the Federal Reserve rate, it affirms 8% chance of a possible 50 basis point cut. We do get inflation data later in the week that could shed more clues on how the FOMC, that's the Federal Open Market Committee, will be interpreting all the fresh data. And a US court judge has blocked Donald Trump from firing Fed Board Governor Lisa Cook. The odds are also high with a 70% probability that the Nigeria Central Bank Monetary Policy Committee will decide to cut rates by 25 basis points in September as inflation slowly abates when it meets on September 22nd to 23rd, with an easing cycle likely to extend into 2026 barring any further upside surprises in inflation. We do get the August inflation print next Monday. To watch, of course, is the foreign exchange rate, which is still vulnerable to crude oil price shocks as global crude supply expands in a lackluster economic growth environment. And of course, the unpredictable geopolitical context lingers. Still in Nigeria, the finance minister, Wale Edun, said yesterday that new tax laws, including a contentious 5% fuel surcharge, will not take effect until January 1, 2026. This is a compassionate rethink to calm fears over rising living costs amid widespread economic hardship. Hello, this is Global Business Insights, where we probe in more depth into the main headlines and share perspectives and thoughts on implications for the business community in the very dynamic context. French President Macron named loyalist Sébastien Lecornu, a one-time conservative protégé, as Prime Minister, the fifth in under 2 years, defying expectations he might lean towards the left. This was after previous Prime Minister François Bayrou lost a confidence vote. Nepali Prime Minister KP Sharma Oli was forced to resign yesterday by angry young anti-corruption protesters who defied a curfew and clashed with police. And this came also a day after 100 people were injured and 19 people died in these protests. The outrage was sparked by a social media ban which was lifted after police fired tear gas and rubber bullets at protesters trying to storm Parliament. Annual revisions to U.S. non-farm payrolls data for the year to March 2025 showing a drop of 911,000 from the initial estimates is definitely significant in changing the narrative on what has been happening to labor markets since over a year ago. Downward revisions since the cutoff date in that report also suggest that the reduction in payroll growth has been actually around 1.2 million for the past 16 months. Wall Street expectations had warned that revisions could be very, very significant even as markets closed mostly higher. In addition, also, if you look at recent months, there is an evident softening with the market data. In June, the June data was revised actually to negative job growth. Looking at the sectors affected by the markdown, the largest hit we saw in the leisure and hospitality sector, down 176,000. Also down with high negative revisions. That was in the professional and business services and retail trade sectors, with most of these revisions in the private sector. Previous high negative revisions got the attention of the FOMC, and we did see sharper rate cuts when these revisions came in this bad. But this time, lingering concerns with inflation may temper bets for 50 basis points. Thursday, that's where we get the August CPI print, could also be more consequential as the FOMC comes under sharper pressure to act as the US economy more obviously seems to be weakening, worsened, of course, by the uncertainty on trade policies. To other business stories, Apple unveiled its latest lineup of iPhones, including a thinner Air model, seen as the precursor to a folding phone coming perhaps next year. Critics lamented Apple's much slower moves in artificial intelligence, as most upgrades are increasingly incremental, except perhaps for the intelligent selfies and smarter camera capabilities powered by the A19 chip. The usually hefty price tag at a time of tighter wallets with higher tariffs feeding into costs could be problematic, with more affordable Chinese gadgets loaded with features also flooding the stores. Analysts were watching how Apple plays the pricing strategy as they seek ways to boost revenue and defray tariff-driven costs. iPhone 17 will start to retail at $799. We could be seeing a new global copper-focused mining heavyweight as London-listed miner Anglo and Canada's Tech Resources announced plans to merge. Anglo-American shares surged 9% as market digested the deal. Anglo-American would own, that's their shareholders, would own 62.4% of the newly combined company Anglo-Tech, while shareholders in Tech will hold 37.6% in a tie-up that still needs the nod of regulators. The race to dominate production of copper used in EVs and key to data centers for AI has led to a stampede into new projects and takeovers. Still on electric vehicles, Japan's Nissan Motor Company is rolling out hybrid cars that use its e-power technology in South Africa as it moves more drivers in Africa's largest economy from petrol engines towards electric vehicles. Still in South Africa, the government sent officials to the US to prepare for trade negotiations after attempting for months to strike a deal to roll back steep tariffs. Also, in South Africa, US retailer Walmart is launching its first branded stores this year. This places Walmart in direct competition with established domestic retailers, including market leader ShopRite, Woolworths. An Israeli surprise attack on Qatar targeting Hamas leadership has led to a spike in crude oil prices. OPEC Plus over the weekend had announced an output hike, much less than prior months at 137,000 barrels per day. That was over the weekend. We could see more upside pressures on prices if President Trump implements harsher Russia and secondary sanctions. In the recent World Oil Outlook 2025 report issued by the OPEC organization, a need for an all-encompassing approach to future energy pathways and energy security closely linked with efforts to reduce emissions and ensure sustainable development was presented. The report highlighted that global energy demand is set to expand by 23% in 2050, driven by expanding economic growth, rising populations, increasing urbanization, new energy-intensive industries like artificial intelligence, and the need to bring energy to the billions who do not have it. The developing world, that's the non-OECD countries, constitute the countries that are going to be fueling the increase in the near and even medium term. The World Oil Outlook observed that the mindset of swiftly phasing out oil and gas is unworkable and actually a fantasy. This mindset is, however, shifting also as the data shows that out to 2050, oil demand continues to expand to reach 123 million barrels a day with no peak oil demand on the horizon. That is in the baseline scenario. The OPEC report finally called for a proactive and constructive approach to investments in areas such as carbon capture, utilization and storage, direct air capture, and the circular carbon economy. This was to ramp up a reduction of emissions and implement lower carbon solutions. Apart from the baseline, most likely scenario reference or the reference scenario, OPEC saw two other alternative scenarios presenting different but viable outcomes. The technology-driven scenario assumes accelerated investments in advanced technologies, resulting in both significant fuel substitutions and energy efficiency improvements that lead to lower primary energy demand and a significantly different energy mix. In this scenario, there was a demand gap vis-à-vis the reference case of close to 5 million barrels per day in 2035, which then expanded to 16.7 million barrels per day in 2050. The second scenario, that's the equitable growth scenario, describes a more equitable and prosperous economic future for developing countries, coupled with a differentiated approach to how and when to achieve emission reduction targets. This scenario therefore saw higher long-term energy demand, with oil demand in this scenario reaching 120 million barrels per day by 2035 and growing to 130 million barrels per day in 2050. But going into the meeting of the 8 OPEC Plus countries yesterday, gathering to consider further unwinding of production cuts, you recall in early August, a decision was taken to boost output by 547,000 barrels per day. That's for September, which completes the rollback of 2.2 million barrels per day voluntary cuts. But there is another 1.65 million barrels per day, which can be unwound, and these cuts were to have been in place until end of 2026. Oil prices have been subdued for most of the past several months as OPEC Plus began in April to unwind production cuts. A decision today by OPEC Plus producers to tap the last 1.65 million barrels per day cuts would signal that they are back to chasing market share. Market share comes at a cost of lower prices, which threatens country budgets, and in many basins like in the U.S. shale patch, can also lead to a decline in drilling investment. Indeed, institutional flexibility has helped keep the OPEC boat afloat. While prices need to be stable and high enough for steady investments, the debate on the long-term outlook and narratives on peak oil demand and supply have to be accurately shaped, knowing that oil is a finite resource, and once extraction surpasses a peak, production will naturally wane due to decreased reserves and newfound challenges to extract these finite resources. Peak demand is also driven by technology and business environment facing tepid economic expansion and an uncertain transition to non-fossil fuels. Despite past generous increases in supply by OPEC Plus, prices have remained stable, though keeping sentiment bearish given the sense of ample supply. The geopolitics and tension points around supply, either from new sanctions or other global developments, have also always seemed to offset the demand lull from a slower economic growth trajectory. Saudi Arabia has continued to remain on the driving seat and for now is juggling maximizing both revenue and market share. The potential lack of cohesion and division amid members facing increasingly tighter fiscal space, and who will in the near future find it more and more difficult to see the longer-term market share or other advantage, cannot be ignored. Ultimately, like we saw Angola recently do, we could see more exits. More special coalitions also are possible, and we could see some type of plurality thriving within OPEC as the odds of a split continues to rise. Still on oil, this time in Nigeria, a former Minister of State for Petroleum and Group Managing Director of the Nigerian National Petroleum Company Limited, Professor Ibe Kachiku, says if the Nigerian oil industry must see a significant leap, NNPCL must be weaned from political interference. Kachiku, who spoke at the Nigerian Content Development Monitoring Board Business Mentorship Online Series 2025, also said regulatory agencies as well as persons appointed to head them must be non-partisan. Well, that's all we can take on this episode of Global Business Insights. Bye for now.